Most people try to build wealth like they're filling a bucket that's already leaking. They pour money into stocks, crypto, or trendy ETFs, while credit card debt quietly drains everything away at 22% interest. It's like watering a garden with a hose full of holes and wondering why nothing ever grows. Before money can multiply, it needs structure, and structure begins with order. Because wealth isn't built on excitement, it's built on sequence. The truth is, most people lose not because they're lazy or unlucky, but because they do things in the wrong order. They invest before saving, spend before planning, and chase returns while ignoring the basics that keep wealth from slipping away. A few changes in sequence can completely change the outcome of a lifetime. When you invest in the right order, every dollar starts pulling in the same direction, like gears working in perfect sync. You stop wasting effort on random moves and start building something that lasts. And once you understand this order, wealth stops feeling like a gamble. It starts feeling like control. Building wealth isn't about guessing which stock will skyrocket or timing the market perfectly. It's about creating a system that works even when life doesn't. Think of it like building a house. You wouldn't start with the roof or the granite countertops if the foundation were cracked. Yet that's exactly how most people handle their money. They skip the groundwork, the savings, the debt payoff, the safety net, and go straight for the exciting part. But skipping steps doesn't save time. It creates collapse. Every mistake in financial order comes with a cost that compounds quietly over the years. A weak foundation doesn't just slow progress, it multiplies stress. Doing things in sequence has the opposite effect. It amplifies stability and simplifies every decision that follows. Because when your base is solid, your money finally starts working for you instead of against you. The right order gives every dollar a clear purpose. It removes confusion and replaces it with direction. You stop asking, "What should I invest in?" and start knowing exactly what comes next. Wealth isn't built by luck or hard work alone. It's built by structure, patience, and sequence. And once you get that order right, your financial life starts to move forward naturally. Before you invest a single dollar, you need protection. Not just from the market, but from life itself. Because life will test you. A broken car, a medical bill, or a job loss can wipe out months of progress in seconds. An emergency fund is your defense against that chaos. It's not just about money sitting in a savings account. It's about peace of mind, the kind that lets you sleep even when things go wrong. Right now, 1 in 3 Americans doesn't even have $500 saved for emergencies. That means millions of people are just one bad week away from financial collapse. When you don't have a safety net, every small problem becomes a crisis. You're forced to borrow, sell investments, or rely on credit cards that trap you deeper in debt. An emergency fund ends that cycle before it begins. It's your psychological armor, the space that allows you to think clearly when life surprises you. So, how much should you save? Start with $1,000 as fast as possible. Then, build toward 1 month of living expenses and finally aim for 3 to 6 months depending on your stability. If your job is secure and predictable, 3 months may be enough. If your income is variable or you're self-employed, build closer to 6. Research from Vanguard found that people with at least $2,000 in emergency savings reported 21% higher financial well-being. That's not because $2,000 changes your lifestyle. It changes your confidence. It turns panic into patience. And in finance, patience is power. Because when life throws you a storm, the calmest person in the room is always the one with cash in the bank. Once your emergency fund is in place, the next step is to eliminate the biggest threat to your financial growth: high-interest debt. Debt is the silent killer of wealth, the invisible tax that compounds against you every single month. Credit cards charging 22% interest don't just slow you down. They reverse your progress. It's like trying to run a marathon while dragging a heavy chain behind you. Every step forward takes twice the effort just to stay in place. People often tell themselves they'll invest while paying it off, but the math doesn't lie. Paying down a debt with a 22% interest rate is the same as earning a guaranteed 22% return, and no market investment can promise that. Every dollar used to reduce debt is a dollar earning instant returns with zero risk. So before buying another stock or fund, focus on the one investment that's always guaranteed: freedom from interest. Start with what's called the avalanche method. List all your debts, sort them by interest rate, and attack the highest one first while paying the minimum on the rest. Once the top one is gone, roll that payment into the next. It's not glamorous, but it's powerful. Some people use the snowball method, paying off the smallest balances first for motivation, and that can work too. The key is momentum, because every payment isn't just money going out, it's pressure being lifted. A paid-off balance feels like a raise, like buying back a piece of your future. Carrying debt while investing is like trying to fill a leaking boat. You'll never stay afloat. So fix the leak first, then sail toward growth, because until your debt is gone, you're not building wealth. You're just building interest for someone else. There's one powerful exception to paying off high-interest debt before investing, and that's your employer match. If your company offers to match your 401k or retirement contributions, you should take advantage of it right away, even if you still have debt to pay off. It might sound strange at first, but the math makes it obvious. An employer match is free money, a guaranteed return that beats almost anything else in finance. For every dollar you contribute, your employer might add 50 cents or even match it fully, giving you an instant 50 to 100% gain. That's something no stock, fund, or real estate deal can promise. If you earn $50,000 a year and contribute 6%, that's $3,000 of your own money. With a 50% match, your employer adds another $1,500 immediately, before your investment even starts growing. That's a 50% return on day one. And if that money stays invested for decades, the compound effect becomes enormous. Skipping that match is like walking past a pile of cash every month and pretending it's not there. The smart move is to contribute just enough to get the full match. Don't go beyond that yet. Focus the rest of your money on crushing high-interest debt. This way, you get the guaranteed returns from your employer while still freeing yourself from the chains of compounding interest. There's only one thing to watch out for: the vesting schedule. Some employers require you to stay a few years before the matched money is fully yours. If you're planning to leave your job soon, check the rules first so you don't lose what you've earned. But in most cases, the math still favors taking the match, because free money is the rarest investment opportunity there is, and those who take it are already one step ahead, building wealth while everyone else keeps giving it away. After you've captured your employer match and paid off high-interest debt, the next smart move is to take control of where your money grows. That's where an individual retirement account, or IRA, comes in. Most people keep pouring money into their 401k because it feels easy, but they don't realize that convenience often comes at a cost. Many 401k plans are filled with limited options, high fees, and managed funds that quietly eat away at your returns year after year. Those tiny percentages, 1 or 2%, don't look dangerous at first, but over decades, they can drain tens of thousands of dollars from your future. It's like termites eating through the structure of your financial house, slow, silent, and devastating. An IRA fixes that problem by giving you freedom and flexibility. You decide where your money goes, which funds you buy, and how much you pay in fees. You can invest in low-cost index funds and ETFs that charge almost nothing, often less than 0.1%. That means more of your money keeps working for you instead of feeding someone else's bonus. For 2025, you can contribute up to $7,000 per year, or $8,000 if you're 50 or older. That catch-up contribution may not sound exciting, but it's one of the few advantages of aging that actually pays. Another benefit of an IRA is portability. If you change jobs, your 401k stays behind, but your IRA moves with you. It's fully yours, completely independent. Think of it as your personal financial lab, where you can optimize your strategy and grow wealth on your own terms. Once you've maxed out your IRA, then it's time to return to your 401k and invest beyond the match. This order maximizes growth, minimizes fees, and gives you full control over your future. Because building wealth isn't just about saving more, it's about keeping what's already yours. Once you know where your money should go, the next question is how it should be taxed. And that single decision can shape your financial future for decades. When it comes to retirement accounts, you have two main choices: traditional and Roth. A traditional account gives you an immediate tax break today because your contributions are made with pre-tax money. You pay no tax now, but you will when you withdraw it later in retirement. A Roth account does the opposite. You pay taxes up front, but your withdrawals in retirement are completely tax-free. So the real question is simple, but the answer depends on your future. Do you want to pay taxes now or later? If you expect to be in a lower tax bracket in retirement, a traditional account usually makes more sense. But if you're early in your career and expect your income to grow, paying taxes now through a Roth could save you far more over time. The problem is that no one knows what tax rates will look like decades from now. Trying to predict that is like trying to forecast the weather next year. Possible, but unreliable. That's why the smartest investors don't pick sides. They diversify their taxes. They contribute to both types of accounts, so they have flexibility no matter what happens later. This balance, known as tax diversification, gives you control over your income when you retire. It allows you to decide where to pull money from based on the tax environment at that time. And that flexibility is priceless, because wealth isn't just about how much you earn. It's about how much you keep after taxes. And learning to control that is what separates those who simply save from those who truly build freedom. There's one account most people overlook, even though it's one of the most powerful tools for building wealth: the Health Savings Account, or HSA. It's often misunderstood as just a medical fund, but it's much more than that. An HSA is the only account in the United States that gives you a triple tax advantage. You get a tax deduction when you contribute, your money grows tax-free while it's invested, and your withdrawals are tax-free when used for qualified medical expenses. That means it saves you on taxes when the money goes in while it grows, and even when you take it out, there's simply nothing else like it. For 2025, the contribution limit is $4,300 for individuals and $8,550 for families. To qualify, you need a high-deductible health plan, which isn't perfect for everyone, but for healthy people, it's one of the smartest financial decisions you can make. The key is to treat your HSA not as a spending account, but as an investment account. Pay for your medical expenses out of pocket if you can, and let the money inside your HSA grow untouched for years. Keep all your medical receipts because there's no time limit on when you can reimburse yourself later. That means you could pay a bill today and withdraw that same amount decades later, completely tax-free. If you max it out each year and earn an average 7% return, your HSA could grow to over $400,000, all tax-free. And after age 65, you can use the money for anything, not just healthcare. For non-medical expenses, you'll pay regular income tax, but for medical costs, it remains fully tax-free. Given that the average couple in retirement spends more than $300,000 on healthcare, this single account can protect your savings from one of life's biggest financial burdens. An HSA isn't just about health. It's about freedom from uncertainty. And when used wisely, it becomes one of the most powerful compounding tools you'll ever own. After you fund your HSA and max out your IRA, it's time to return to your 401k and push your contributions further. This is the stage where your wealth starts compounding in a powerful way, because you're now stacking multiple tax-advantaged accounts that protect your money from constant taxation. For 2025, you can contribute up to $23,500 to your 401k, or up to $31,000 if you're 50 or older. That means a huge portion of your income can grow in a space where taxes don't drag it down year after year. When investments grow without constant tax friction, they snowball faster, and that difference becomes enormous over time. If you invested $10,000 a year for 30 years with compounding and tax benefits, you'd end up near $944,000. But if that same money lived in a taxable account, constantly losing a portion to taxes on dividends and gains, your ending balance could be around $700,000 instead. The gap isn't due to luck or skill, it's the silent benefit of tax sheltering, and most people never experience it because they get distracted by short-term excitement instead of long-term discipline. Once your contributions are automated through payroll, saving becomes effortless and consistent. You don't rely on willpower, you rely on structure. The money moves before you even see it, which means you build wealth on autopilot while living your life. This is where your financial engine truly starts running at full speed. quietly compounding behind the scenes while you focus on your goals. Because real wealth isn't built in bursts, it's built in systems that work whether you're thinking about them or not. After you've built your foundation, paid off debt, and maxed out your tax-advantaged accounts, you reach the final stage, taxable investments. This is where flexibility begins. A taxable account doesn't have contribution limits or withdrawal rules. You can use it to invest for early retirement, buy a home, or fund any goal that matters to you. But that freedom comes with a hidden cost: taxes. Every time you earn dividends or sell for a profit, the IRS takes a slice. That constant drag slows compounding over time. That's why taxable accounts should always come last, after you've exhausted every tax shelter available. Once you get here, though, the advantages are powerful. You can access your money whenever you want, no penalties, no restrictions. It's perfect for people aiming to retire early or build wealth they can actually use before 65. And when you hold assets long-term, you qualify for lower capital gains taxes, which helps your money grow faster. It's also an incredible tool for building legacy. Under current law, your heirs receive a step-up in basis, meaning much of the growth can pass to them tax-free. So, while tax-advantaged accounts build security, taxable accounts create flexibility. They give you the freedom to use your wealth strategically, to enjoy life, take risks, or give back. This is the point where wealth stops being a goal and becomes a tool. Because when everything is in order, money no longer controls you. You control it. And that's real freedom. In the end, real wealth isn't about chasing opportunities or predicting the next big trend. It's about following a sequence so simple that most people ignore it. The truth is, financial success often looks boring from the outside. It's the person who saves quietly instead of showing off. It's the one who builds an emergency fund before taking risks. It's the one who pays off high-interest debt before buying investments. It's the one who takes the free money from an employer match, who studies taxes, and builds patiently while everyone else gets distracted. Because wealth isn't a race, it's architecture. Each layer supports the next, and skipping one means rebuilding later. Your emergency fund is the foundation. Your debt payoff is the structure that holds everything together. Your retirement accounts are the walls that protect you from the storms. And your taxable investments are the windows that open to freedom. None of it looks exciting in the beginning, but it's exactly what builds peace later. The people who follow this order rarely look rich at first. They look calm. They look in control. And eventually they wake up one day realizing their money has been quietly working for them the whole time. Because wealth doesn't reward speed. It rewards sequence. And those who master the boring steps are the ones who end up free. If this video helped you see money differently, please like and subscribe. It helps this channel reach more people who are quietly building their own version of financial freedom, one simple, patient step at a time. And if you've made it this far, comment walnut. Let's see who's still here when the next cycle begins. See you in the next video.